Us, of course, a great mind on micro as well as macro. So Manish, it's where do I start off? Actually, is where I'm puzzled. But let me start with the macro first. Try and get your top-down view with regard to all that's playing out. If at all there's a resolution, and there are talks of one, and there have been talks of one since a month. Firstly, should we believe it? Secondly, how quickly can markets re-rate, if at all that were to come through?
So we exactly don't know when this whole thing will get resolved. Every day we hear that it's getting resolved, but it doesn't. So I think the chief, deciding factor out here would be the announcements by the RBI to raise FCNRB deposits, because the main problem of India has been the currency. And I think from 97, if we get around $40 to $50 billion on account of FCNR, ECB, then that could be a very helping hand to the currency. I think currency in all probability would be headed towards 93, 94 if we were to have oil at 100. So obviously if there's a resolution, oil heads towards, let's say, 91 or 85 to 90 on the Brent, then 90 to 91 or 91 to 92 on the currency is also doable. So in that backdrop, whether the war gets resolved now or maybe 3 months later, is basically not going to matter much on the direction of the markets. I think markets are decisively on the positive side because we have got a breathing space for the next 3 months till 30th of September 2026, whereby we will likely receive $40 to $50 billion, and that would be a great helping hand in terms of deciding the sentiments for the market and in terms of absorption of the selling pressure that's coming about from the FII. So that's how I would read it. Everything else is basically positive from the fourth quarter earnings point of view, large cap, mid cap or small cap. There's a lot of shorts in the system and, things don't look that bad from a micro standpoint as far as India macros are concerned. But global macros, I think this timely announcement by the RBI is a great helping hand.
Yeah, I mean, you've summed it up very well. But Manish, what really stood out for me in terms of the response you just gave is it's going to be largely rupee linked, right? So you seem to be of the view that if the rupee moves lower, you could well see a decent re-rating because FIs could come back. So it's going to be rupees and the rupee and flows. Is that what you're really focused on as the key drivers for the re-rating?
No, I think the problem on the currency, apart from the FI outflows, has been the import bill on account of oil, because oil is at 100. That is very, very damaging from a currency point of view. What I meant was that, FIs are likely to, or let's say rupee is likely to bottom out in all respects when we see the market realizations and market pricing of petrol and diesel to global international prices of crude. That is one. Or we see an interest rate hike to the extent of 50 to 75 basis points. That is when we actually price in the reality. So, in this sort of circumstances, if these two things were to come about, then I think from an FII point of view also, you could likely see some, withering of the selling pressure that you're seeing from the FIs. But this FCNRB is likely to help the macros and the currency from the point of view of an import bill. That is what really is mattering at this given point.
Manish, hi, morning. If this conflict continues for a few more months, while there's lots of talk about a final deal getting signed, but this deal has three parties: US, Israel, and Iran, and it's only the US which is talking about it, not Iran and Israel about it. No news coming from their end. If this goes on for some more time, what is the kind of impact that you see on the earnings? Because that's something we almost at the end of first quarter, we are going to see a second order impact of inflation also coming through at some point in time. You have CPI numbers expected for the month of May, which will be more than 4%. So how do you look at that on the company's profitability, margins, and as a result of overall earnings growth?
First quarter numbers are going to be damaged when we compare this first quarter numbers compared to the fourth quarter of last year. So fourth quarter numbers were very, very good, especially for the broader markets per se, where you saw the mid cap grow by north of 40%, small cap grew by north of 25%. large cap NSE 100 grew by around 14-15%. So earnings were very good for the fourth quarter. That's not to be extrapolated for the first quarter. But what is likely to happen is that if we have a resolution by the end of anytime between now and let's say September 30th, 2026, then this first quarter numbers could be likely seen as a one-off because all hinges on collapsing of the oil prices because that is the main source of inflation apart from your very weak monsoon. These are the two major items which are weighing on our inflation numbers predominantly. And I think if oil was to fall, below 85-90, then we'll have that problem looked upon as a one-off for the first quarter. And then resumption of the journey of around 12 to 13% earnings growth for the Nifty 50 for the remaining part of the year. If not, then obviously there's going to be damage on earnings per se. If let's say oil is between $90 and $120, if this resolution doesn't happen, maybe we are not going to see that big an impact from a currency standpoint because currency, I think at 97 has probably bottomed out. We are likely seeing rupee at 93, 94. So imported inflation component is likely to wither down on account of currency, but oil remaining between 90 and 120, will be taken care of between now and between now and September. If it continues beyond that and oil flares beyond 120, then we have a serious problem on earnings for the rest of fiscal 27. But right now it is a one-off for the first quarter.
Manish, interesting that you said that, when we're talking about 15 plus earnings growth for the benchmark, we were looking at oil at $65, and now we are saying that between 90 and 120, if oil remains, it won't have much of an impact on the earnings?
No, it will. Basically, on the base case scenario of 15% before the crisis to after the crisis, this Nifty 50 earnings numbers have come down to 12-13% according to us. And this builds in a damage to earnings for the first quarter. But if this war prolongs beyond, let's say, 30th of September and there's no visible solution, then obviously earnings are likely to traject even downward from the base case scenario of around 12 to 13%. Right now, the base case scenario is that we are probably close to somewhere near the settlement. So first quarter damage to earnings is likely to be a one-off, and resumption of the growth journey on earnings for Nifty 50 will likely be from the second quarter onward. So today, that's the base case scenario. Of course, everything hinges on the fact that you have a resolution in that backdrop. You'll have oil below 90 or at about 90 as the base case scenario, and that should be basically taking care of the earnings for the remaining 3 quarters.
The street seems to be building up so much of anticipation to the FCNRB inflows. We already seen some of the banks putting out rates of 6.5%, 7.1% as well. But do you see enough flows coming in? Because compared to last time in 2013, the spread is also much thinner with respect to the Indian rates and the overseas rates.
No, there will be likely inflow because the simple math is that if you're giving the 3-year deposit rates at around 6 to 7% and the cost of hedging, etc., is taken care of, and you have a leverage factor. It's not that it's one-time leverage. If you're lending at 9 to 10 times, then obviously 1 or 1.5% spread on 1 rupee of capital, if you're leveraging or you're lending, 10x, then obviously the return to the investor is anywhere between 15 and 20%. And that too in dollar terms. Of course, there are a lot of ifs and buts in terms of risk. But on paper, it looks like that 15 to 20% dollar sort of returns is very much doable under the context of lending to the borrower by these banks to the extent of 9 to 10 times. And what I'm saying is $40 to $50 billion combined on account of the fact that you have inclusion in the bond market index, or you have ECB flows or FCNRB flows. Cumulative, you should be looking at $40 to $50 billion. I don't think it's very atrocious assumption at this given point in time because this capital gains tax has been done away with. It's definitely a positive from the flows point of view on the foreign exchange fund.
Okay. Manish, bottom up, let's start, kind of decoding those views from you. In terms of sectors, in terms of stocks, what is it that you're finding attractive at this point of time?
Look, the predominant themes which are very attractive, from a global standpoint, I'm not only talking about India standpoint, is the energy transition. This vulnerability of all economies globally because of fossil fuel dependence on account of the Middle East is given way to maximum, focus on this theme. Of course, finding individual names in this theme is another ball. You got to basically take your call on how the valuations look at, because near-term valuations on most of the names catering to this theme is probably full. We are going to look at 28, 29, and 30 if you have to make money, but predominant theme in global context, including India, is the energy transition, whether solar, wind, battery energy, pump hydro storage, electric vehicles. This is going to be the predominant thing. Second is basically the AI theme, which is there, all pervasive globally. So data center ancillaries are likely to be doing very well. And the third major theme in India's context, where there is a lot of attention, is advanced manufacturing, whether it is aerospace, whether it is defense technologies, medical, semiconductors. These are some of the all-pervasive themes, and these three themes today are very, very focused in terms of how the action is being played out in the market. Most of these themes are well discovered. Most of them are very well priced for the next 2 years. One needs to look beyond FY28 to make money in most of the names, but these are the predominant themes in today's times.
Okay, and how exactly do you play AI, Manish? Give us a sense of that. Because, I mean...
Data center ancillaries, whether it is chillers, whether it is, let's say, connectors and, optic fibers and cables and critical minerals, so on and so forth, because we hardly have any play on the chip front, we hardly have any play on the RAM front or memory front. These two make up closer to 80%. America is moving from 65 gigawatts to 130 gigawatts by 2030. We are aiming from 1.5 gigawatts to 5 gigawatts. And in that, we don't have a play on the chips and this. But whatever remaining 20% is basically being looked into by the remaining, the themes, that the sectors that I alluded to.
I take your point. How do you look at IT, Manish? Tough to kind of ignore that sector, but at the same time, there are such diverse views.
Yeah, so, the primary large language models, India doesn't have a play. Whenever there is a use case that comes through, Indian IT services will be able to leverage through the use cases, because AI is a new technology. And as like with any other technology which is there, India makes itself relevant, of course, after a hiatus, after some point in time. So today, the primary large language models is not our prerogative, but whenever there's use cases will be relevant. In today's context, IT services basically are a deep value play. Most of these names are trading at 5 to 6% free cash flow each. 14 to 15p, there may not be a case of very strong buying, but there is not also a case of very strong selling. What we are seeing currently is the de-rating in P multiples, the damage to earnings is broadly priced in. We are still looking at single-digit dollar revenue growth from the next 2 years point of view, but markets are probably telling you that the next 5 years point of view, this sector is going to see a damage to earnings. I don't think so. The de-rating on the multiples from the next 2 years point of view is done. But still, this sector as a whole is trading at very deep value.
Manish, I take your views on the IT, but from a company's point of view, do you see Indian companies being agile and quick to transition themselves to manage that kind of change with respect to what AI is bringing in?
Yeah, so large companies will be slightly more headwinded, because training of such a large workforce is going to be challenging. But mid-cap IT companies should be able to transition those who are having a lesser workforce. The learning curve is going to be there, but it's easier for mid-cap, small-cap companies to transition as opposed to large-cap companies. Predominantly because AI revenue as a part of the large IT services company would still make a very small percentage, because a bulk of them comes through application development and maintenance or infra management and all of that. That's on a declining curve. So all in all, mid-cap companies, small-cap companies are better.
Okay, mid and small is the better bet here. And give us a sense, Manish, in terms of asset allocation. you've gone through enough cycles to know how this plays out. You've got gold at about $4,200 on the ounce at the current juncture. How should one allocate between gold, given inflation risks, and equities?
No, so today it's a liquidity-driven event when money is getting pulled out from all asset classes because you have very large IPO, SpaceX. It's basically subscribed 4 times as what we read in social media. $75 billion has already got subscription of $250 billion. $1.7 trillion IPO. You have 2 more $1 trillion IPOs, Anthropic and open source. So it's basically liquidity tightness that's happening because money is getting pulled out from other asset classes to be deployed in this asset class. Once this whole thing gets settled down, then I think the critical minerals, even gold will have its play, and silver will have its play, and copper and aluminium, they'll also likely do well. In terms of asset class, I think predominantly gold and silver should have a place of around 10% in your portfolio at all given points in time, is what my thinking is. Because, over long periods of time, this asset class has also given you 8-9% CAGR. Of course, in rupee terms, over long periods of time, 25, 30 years. So, and I think the outlook going for critical minerals, of which silver would also be a part, and in the AI semicon environment, it's a good play to be in from the long-term point of view, and nothing better than if you're able to buy them at discount to what prices we have seen in the past. So I'd be a buyer, but to the extent of around 10% of my.
All right. Thank you so much, Manish, for coming in. That's all the time we have. Unfortunately, I'd love to keep going on, but thanks so much for coming in as always and giving us your views.